Hi everyone, welcome to the Buffett and Beyond Saturday ETF report, and today we're going over our tech and semiconductor sector, and we're going over the housing industry, which has been booming lately. So folks, let's start. March 23, 2024. Remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest better than Warren Buffett does now. And let's look at the tech sector over the past 5 years. Black line is the S&P 500, and the XLK is what we use for the tech sector. There's other ETFs that follow the tech sector, but we use this one. And you can see that it has pretty much more than doubled the S&P 500 on this is a compounded basis over the past 5 years. So we want to pick the best stocks out of this ETF because not only do we want to outperform the S&P 500, and remember that over any 10-year period, 96% of professional portfolio managers who run their publicly traded mutual funds cannot outperform this black line down here. But if we bought the technology ETF, we would have doubled the S&P 500 over these past 5 years. But we want to do even better than that because any ETF, any index has above average stocks and they have below average stocks. So what we want to do is pick the above average stocks and even outperform this XLK up here. So let's see if we can do it. Now this is just this year. So we have we have 6 of the top stocks out of this ETF, and we can see that the XLK, the technology ETF, is up 9%. The S&P is up a little under 9.9%, but our top stocks are up 14.6%. So let's take a look over the past 5 years and see how our top stocks have done. So when we look at again, this is the 5-year chart, black line S&P 500. This mustard-colored line is the XLK, the technology ETF. So the S&P 500 over the past 5 years. Now, this 5 years up here is about 3 months different than the compounded rate down here. That's why the S&P is a little bit higher on our 5-year compounded. But the XLK is up 180%. Okay, not quite double the S&P 500. But look at the top stocks. Our top stocks, and I just showed you 6 of them right now. Our top stocks are up 439%. This is compounded over 5 years. So we're quadrupling the S&P 500. We're more than doubling the ETF itself. So if you had to pick a point, we would be right up here with those stocks that we pick out of the XLK each and every year over the past 5 years. Now, let's look at the semiconductor. Oh, looks pretty much the same, doesn't it? So here's the S&P 500 down here, and here's the XSD. We use that for the semiconductors. As I mentioned, there are many other ETFs that follow the semiconductor industry, and this is the one that we just happen to use. So again, it's almost doubling the S&P 500. Now, let's look at our top stocks, and we have 6 stocks from the semiconductor industry. Now this is just this year, so we're looking at a touch on 1 week shy or 10 days shy of 3 months. Semiconductor's not doing that well. It's up 1.5% with the S&P up 9.9%. But look at our top 6 stocks up 21%. So folks, we're doubling the S&P, more than doubling the S&P 500, and just kicking the hay out of the XSD, the semiconductor ETF. 21% in just a little bit less than 3 months. Let's see how we've done over 5 years. So here's that 5-year chart again. Come down here, compounded, S&P up 109%, the semiconductor up 182%, very similar to the tech ETF, isn't it? And our top stocks, and in our case, 6 top stocks, up 406% on a compounded basis. So again, we would be somewhere up here if we had to draw a line from the beginning all the way up here. Nice going. So if you do your homework, or if we do our homework and then let you know which stocks to buy, this is the way to do it, folks. I mean, think about it, 400% in 5 years, folks. On a compounded basis, that's 80% a year. Of course, we're not getting 80% a year, but when you compound it, leave the money in, let it grow, that's what we're getting. All right, now let's look at the QQQs. The QQQs up to date is up about 8.9%, with the S&P up 9.9%, and our top 12 stocks up 19.5%. Now, had we been hedged 10%, we would have been up 16.6%. So what you're doing is we can hedge with an inverse triple ETF. So if we put up 3% of our portfolio money, we can get a 10% hedge. Actually, 3.3%, we would get a 10% hedge. So we have more money to put into these 12 stocks, and then we lost on the hedge 2.2%. So we would be returning about 16.6%. That's 10% hedged over the past little bit less than 3 months. Folks, these are fantastic returns, and the year is just starting. Now, promise the home builders. So let's look at the home builders. And this is just this year. This is 2 months and 3 weeks to be exact. The home builders are up 16.1%. S&P 500 up 9.9%. So the home builders are coming to life. But what if you had our top stocks? And in this case, we have 8 stocks, and those 8 stocks have returned 23.8%. Folks, more than doubling the S&P 500, not quite doubling the ETF itself. But this is a great return. To do a little bit more work, you find out using the clean surplus accounting methodology which stocks have the highest clean surplus return on equity, and that's what we do, and we use those stocks. So in other words, we're picking up the above average stocks and we're leaving the below average stocks for somebody else to buy. And that's how we can outperform the ETFs all the time. Home builders up 16.1%. Our top 8 stocks up 23.8%. Now let's look at the home builders over 5 years. The top stocks, well, the S&P up 109%. XHB up exactly 200% over 5 years on a compounded basis. Our top stocks almost doubling that at 354%. Not bad, is it, folks? So how about the home construction? Home construction's up 12.2%, S&P up 9.9%, but our top stocks, in this case, we have 7 stocks, and we're up 16.4%. Again, outperforming the S&P 500 by a long shot. So any of these portfolios that we suggest in these specific ETFs are all outperforming not only the S&P 500, but they're outperforming the ETF itself. Now, let's look at compounded over 5 years. S&P up 109%. The home construction up 220%, so doubling the S&P 500. But if you pick the top stocks that we suggest, you'd be up 400%. Folks, that's a big difference between buying and holding the S&P 500 and buying and holding the top 6 or 7 stocks in the ETFs that we suggest. And every now and then we will change a stock in there or replace it or add to it. And that's why you have to read our newsletter so you know exactly what we're doing. Now, let's put them all together. So let's look at, again, over 5 years, 109% for the S&P 500. Tech up 439%, our top stocks. The tech ETF is actually up 180%. Our top stocks are more than doubling that at 439%. The semiconductors up 182%. The ETF, our top stocks in that semiconductor ETF, 406%. Home construction up 220%. Our top stocks up 400%, and with home builders up 200%, you can see that home construction and home builders are quite similar in there because they're all in the housing industry, and the top stocks in our home builders up 354%. So folks, you can see that by doing your homework or just following us in our newsletter without doing the homework, we do the homework for you, you can be doubling the ETFs, and the ETFs are doubling the S&P 500. Actually, the average return for these stocks are 200%. The average return for our top stocks in those ETFs up 400%. So you can outperform the S&P by 4 times over 5 years, over these past 5 years. And folks, the S&P has been doing very, very well over the past 5 years, averaging about 15% per year, which is above normal. So we've had an above normal 5 years, and our stocks in here up an average of 400% in each of these ETFs, or if you average all these 4 ETFs by themselves. Very, very nice returns that we're getting here. And remember, again, 96% of professional money managers cannot outperform the S&P 500 over any 10-year period. That is 96% of professional money managers cannot outperform this. And look what you're doing, folks, by either being in the right ETFs or being, better yet, being twice as high as the ETFs, being in the best stocks in those ETFs. So, folks, we had a very good week this week, and you go out. Hope it's a beautiful weekend. Clear your heads. Don't worry about the market, because you're doing well if you're following any of our strategies. Buy and hold. You're investors. You're not traders. So if you want to invest in the best companies, because think of stocks like McDonald's, think of stocks like Costco, think of stocks like Coca-Cola that are making money every single second of every minute of every day of every year. Those are the kind of stocks you want to be in. Now, we are not in McDonald's and we are not in Coca-Cola, but we're in stocks that continually make money each and every day. Yeah, Costco is one of them. So, folks, you go out, clear your head, be with your family, be with your loved ones. Most of all, stay safe, and we'll see you back here next week.